Well, welcome everyone. Thank you for joining us today. My name is Bob Maurer, and today we're going to be working together with American Ag Marketing and Trading Company. I'm with Manduka Trading as part of Manduka webinars. This will be the last webinar that we have for the year, and it ends on a good note with American Ag Marketing and Trading Company coming on and hosting and presenting for us on this great topic, which is one of the great markets I like to trade, that being the options market. So it's going to be a really good introduction here. This is going to be our last webinar of the year. We'll be starting a whole new series come 2014, so we'll keep you posted on those as soon as our calendar fills up. And as mentioned, it's going to be on options. It's going to be a great little content here because it's not only going to be from the perspective of speculators, it's also going to be from the perspective of the hedgers out there. And it really can be two completely different points of view as to why you're getting involved with the futures or the options markets when you consider those two different types of traders and why they're in the marketplace. And Sherwood's got some really good insights because he deals with hedgers and speculators. So we will be opening the seminar up for questions afterwards. If you have a question along the way, feel free to go ahead and just post it. If you haven't used this before, this GoToWebinar, you might see a little toolbar like I show right there, and if you want to enlarge it, you just click on that white arrow pointing to the left, and it'll create a larger toolbar like what you see right here. And then all you need to do is just enter your question where it says enter a question for staff, and then hit send, and we'll be able to field the question for you. So I will leave it at that, and I'm going to hand it over to Sherwood. So one moment here, I'm going to hand over the reins, and Sherwood can take it away.
Good afternoon, everybody. This is Sherwood Tucker with American Ag Marketing, and thanks for the introduction, Bob. Appreciate that, and thanks for having us on to go over this topic of basic call and put options for hedgers and speculators. While I introduce myself, I'm going to put up this page. It's a disclaimer. Obviously, there's risk inherent in futures and options trading, and our compliance department will be very happy that put this up before the presentation. But while you read through that, again, my name is Sherwood Tucker with American Ag Marketing. We're based out of downtown Chicago. And personally, I've been in the futures commodities businesses for 20-plus years, working with both speculators and hedgers. And thought this webinar would be of value to both sides of the market with speculators and hedgers because my experience in working with a speculative client is that they're unclear as to how and why hedgers use the futures and options markets, and I think it could give them a distinct edge if they did know why hedgers did use these tools. And on the flip side of that, working with hedgers, whether they be new or even experienced, is that they're also unclear as to how some of these tools with the futures and options markets could, and the concepts behind those, could better help them protect their operations and enhance the bottom line for their production. So without further ado, we'll get into the basic here. It's kind of the nuts and bolts, and if you're experienced in the options market, this will probably be a little bit boring to you, but we'll get through this quickly. And basically, a call option, it's a financial contract between two parties, the buyer and the seller, which the buyer of the call has the right but not the obligation to buy an agreed quantity of a particular commodity, which is the underlying, from the seller of the option by a certain time, which is the expiration date of the option, and for a certain price, which is the strike price. And with the CME and CBOT options, it's all standardized and legalized by the exchanges themselves. If you're a speculative buyer of a call option, you're purchasing that option in the hope that the price of the underlying asset, whether it be corn, beans, cattle, goes up before that particular option expires. And there's some statistics out there with options, if you're a buyer, that 80–85% of options that you buy expire worthless. We'll get into that a little bit later too. But the risk of the buyer of the call option is limited to the amount of the premium paid to buy that particular option. Same thing with a put, and we'll get into puts here in a little bit too. But so whether you buy a put or a call for $200, $300, $1,000, $2,000, your risk is limited to your initial investment, so there's no chance of margin calls and bad things like that happening. If you're a hedge buyer of a call option, you're basically purchasing that option hoping that the price of the underlying futures market falls. And it sounds a little bit counterintuitive, but if you're buying a call as a hedger, it's a type of an insurance policy to protect from higher prices because you have input costs, such as if you're a cattle operator, you need to feed your animals, so you're going to have to feed them corn, wheat, bean meal, that type of thing. And if the prices on your inputs go up, you're going to be losing money in your operation. But if you protect those input prices with call options and those markets do go up, then your call options are going to go up in value as well. Also, with hedgers, a lot of grain farmers, if they sell their physical grain at the elevator, a lot of times we'll recommend re-owning some of those bushels on paper, whether it be all of them or half them. It's just a good idea in case the market, turns around or starts going higher. They can still participate in that market going higher with the call options once they've actually sold their physical grain. Call option, the seller, on the flip side of a call option, is obligated to sell that underlying asset to the buyer of the call, again, at an exact price, the strike price, if the buyer decides to exercise that option. Also, the seller or the writer of the call option, the risk is unlimited, so unless you own the physical, unless you're a hedger. So if you're a speculator and you sell a call option, your risk is unlimited because theoretically the market could go to infinity. But if you do own the underlying physical commodity, whether it be grain, cattle, crude oil, etc., then you can offset that by selling your physical. The speculative seller is betting that the underlying asset's value is not going to rise so that they can keep the premium that they get when they originally sell the option to the call buyer. You got to look at it too that if you do sell call options, your profit's capped and you have unlimited risk. Again, if you're speculative, the hedge seller of call options is willing to give up some of the upside profit in potential in return for the premium that they got paid from the buyer of that option, and retaining the opportunity to make a gain up to the strike price. So the hedger's selling a call option, they're looking to get some premium in, and they're willing to sell at a higher strike price than where the market may be trading now. But if the market does go down, then obviously they need to be protected on the downside too. But it gets some additional premium, and if the market does go up, they get to sell at a higher strike price, and they're happy with that, and they get to keep the premium too. It's a little bit of a graphical representation of being long a call option, not short, but being long. And this has no time involved. And I realize it's a stock, it says stock price at expiration, but if you go over here to the left, here's zero, profit and loss. And when you start out, obviously you're buying, so it's a debit transaction. And then as the underlying starts to rise in price, your call option is going to go up in value. And again, with calls, it can be unlimited, depending on how high the market goes. Some advantages and disadvantages. We'll start out with the disadvantages of call options. So if you're, again, a speculative call buyer, the time decay of the option is going to work against you. So if you buy a call, it's got what's called a theta. It's the time value of that particular option. And a lot of times in my experience, people who are buying options, they want to pay the least amount as possible cash outlay. But don't be fooled by shorter term options being cheaper in value. And an example I'll give you on that, as I just went through this today for this, is that if you look at March soybeans right now, they're trading around $13.10, and you can buy a February of 2014 1310 call, which is right at the money, for about 30 cents or $1,500. That particular option has 37 days until expiration. If you go out to the May bean options, the futures are trading at $13, so 10 cents lower than the March beans are. And you could buy it at the money $13 call for 54 cents or about $2,700. And you have 128 days till expiration on those particular options. So if you do your math, paying 30 cents for an at-the-money option with a little bit over a month to go, and obviously you're paying less than the 54 cents, but you have a little bit over 4 months on that option that you're paying 54 cents. So if you break that down, you're paying 13.5 cents per month for that particular option, whether you're buying it speculatively or whether you're buying it to protect yourself on the upside in the case of a call. Also the same thing in the case of a put. So you're paying half the amount that you would for the February option per month. And it's a lot of things I'd like to point out to speculative traders and hedgers, just to save them some money on the premiums when they're out there buying options. Obviously, it's the opposite if you're a seller of options, but can discuss that further. Some advantages for speculators are also cheaper than buying the asset outright. So your outlay on controlling a futures contract, for example, I think the margin on soybeans right now is $4,725. You open yourself up to margin calls. If the market goes against you, keep sending money into your account to keep that position. You can control the same amount for less amount of money. And obviously, if the market does start going your direction, the call is not going to go up the same amount as a futures contract. And we'll get into that too, probably in future webinars. It's called a delta, the percentage that option is going to move in relation to the underlying. But your risk is capped and limited to the amount you buy that option for. There's unlimited profit potential if you're long a call option. Again, no margin calls. And when you enter into these contracts, whether it be a put or a call, you can get out of it at any time. So if you're profitable on that option, or you've protected yourself through the time period you want to, and you want to get out of it, you can sell it anytime you want to, or if you're short, buy it back to either lock it in profit or cut a loss. And if you own the underlying futures contract, you can sell call options to collect premium against that, which is going to lower your cost rate basis and bring in some revenue for you. It's called covered calls. A lot of people do that in stocks and also in futures if they do own the underlying. It doesn't protect your downside, but it's a way to lower your cost basis. Also, call options, they allow you to stay with the trade, let you be able to sleep better at night knowing your risk is limited. And if the position does, when you put on your trade, start moving against you, then you can hang with it. It's less volatile. It's going to move less than a futures contract's going to. So it helps you smooth out your trading psychologically a little bit. Some advantages of call options for hedgers: it allows you to protect against higher prices in the futures markets. So you're better able to control your input costs, like we talked about, whether it be feed, or if you're an airline and you need to protect against fuel prices going higher, interest rates going higher. That's what buying call options is there for. Also, lets a producer, I think we went over this a little bit, sell their physical grain to an elevator and then re-own those bushels on paper for a fraction of the cost, and then less risk than holding onto their physical grain, whether it be still in production or they put it in the bin. And if the market does rally after the physical sale and you re-own it on paper with call options, you're still going to participate in that upside move. Best example I can think of recently was in 2012, where a lot of producers had sold a lot of their grain forward for 2012 and even some 2013 grain. And then the drought hit, Mother Nature turned off the water, and grain prices went skyrocketing, and they didn't own their grain anymore, so they couldn't participate in that. And that's why we recommend buying some call options, because if a situation like that develops, you're still going to be able to participate in market rallies. Also, for a hedged call seller, the call option allows you to collect a premium while you're holding on to the physical grain if you're anticipating higher prices. So if the market rallies to or above the strike price, you keep the premium that you sold that call option for, and then you end up selling your grain at the strike price, which you agreed to when you sold that call option. So it's kind of the best of both worlds. Again, there's unlimited profit potential if you're long the call options, and there's no possibility of margin calls. And you can sell your call option at any time too if you're a hedger, just the same as if you're a speculator, whether it be to cut the loss or lock in a profit. Getting into put options, same thing, financial contract, just as a call option is between a buyer and a seller. Buyer of the put has the right, not the obligation, to sell an agreed quantity of the particular commodity from the seller of the option by a certain time, the expiration date, for a certain price, the strike price. So the speculative buyer of a put option is going to purchase that in hopes that the price of the underlying asset is going to fall before the option expires. And the buyer of the put option risk is limited to the amount of the premium, just like a call option. If you're long the put, long the call, your risk is limited to that premium. If you're a hedger, you're going to be buying a put option in hopes that the underlying market's going to rally higher so that you can sell your physical grain, metal, oil at higher prices. And you're actually hoping that the value of that put option goes lower and you lose your money in those put options, because that means you are going to be able to make higher cash sales. So you're buying the put option as a hedger as a type of insurance policy for falling prices. And that put's going to increase in value as the market prices go lower. So it's going to help you offset a little bit or most of your loss on the physical side of things. If you're a speculative seller or writer of a put option, you're obligated to buy the underlying asset from the buyer of the put at an exact price, which is the strike price again if the buyer so decides. They decide to exercise it or they don't have to. And also, if you're a seller or writer, your risk is the strike price down to zero. So it's not unlimited, but it basically is because, for example, in the Dow Jones, if you sold a $15,000 put or 15,000 point put, and the market went to zero, your risk is from 15,000 down to zero. Again, selling options, your profit's capped, and to the premium you collected, and your risk is basically unlimited. Another reason a speculative trader may sell a put is that they're willing to buy the underlying futures market at a specific lower price, and you want to collect a premium until the market trades down to the strike price of the option you sold or the put you sold. And if the market does rally higher, you can keep the premium. So, for example, if you thought silver was a great buy at $17 and it's trading at $18 right now, you're willing to buy it at $17, you can sell the $17 put, collect the premium. The market drops down to $17 or below, you're going to be assigned, so you're going to be buying that futures contract of silver at $17, keep the premium, and then obviously hope that prices are going to rally from there if you're a spec trader. If you're a hedge seller of a put option, this is a little bit unique. If you have questions on this, let me know. But you're hoping that the market maybe fall lower in the future so that you can buy your inputs, again, fuel, interest rates, metals, at lower prices, and you're going to collect a premium to do so. But to keep your risk balanced, what we normally recommend doing, if you're going to collect a premium from doing that, and you'll be happy if, like, for example, corn's trading at $4.20, and you end up selling the $4 corn put, and you end up buying your corn to feed your animals at $4, well, obviously that's better. You get to keep the premium. But in case the market doesn't fall to the price level and you don't get to buy your feed at those prices, then take the premium and buy some call options on top of the market. So if the market does get away from you, start going higher, where it's going to cost you more money on the physical side, you're at least covered with the call options. So it'll help you mitigate some of those extra expenses. Another graphical representation, like the call, it's flipped. So your max profit is right here, where it's zero. So that's when you're going to experience, if you're long a put, your max profit. And then as the market goes higher against you, your risk is going to be capped. In this case, $200 you paid for that put. So that's the most you can lose on that is the $200 on a long put. Some advantages and disadvantages, starting with the disadvantages, same thing. Time premium is going to work against you if you're long the put option, so give yourself plenty of time on that. Use the math equation we went over before, price your options out month by month, so you know that if you're buying longer term options that it actually is more of a value, even though you have to spend that more money at the time of buying, you're buying a longer time period, and that's what it comes down to. You can sell them at any time, so you obviously have to have a trading plan to cut your losses and options if the market isn't going your way if you're a spec. If you're a hedger, that's a little bit of a different story. If you buy a put, potential loss of 100% of your money, it says call option here, but it's put, if the underlying market fails to close above. So again, we have this backwards here. It's my fault. But we're talking about put. So if the market doesn't go below the strike price that you bought that option at, then you're going to end up losing 100% of your money on expiration. High leverage can be dangerous if the underlying asset moves against you. So don't overtrade your account, meaning don't buy too many positions per your account size, or don't replace more bushels than you sold, or buy more options than you need to protect. So for hedge put buyers, the put option's not going to protect you tick for tick in the underlying market. The put option is going to go up in value a certain percentage to the underlying futures depending on the specific option's delta. So if you have any questions on that, let me know. It's a little bit more of an advanced concept, but the put option is not going to move tick for tick for the underlying. Some advantages for speculators is that it's cheaper than short selling the underlying asset outright. There's no margin call, so if you enter into a short futures contract, you open yourself up to margin calls, and you have to put out more margin to hold that position. And if the market goes against you, you're going to be asked to send in some more margin to meet those requirements. Excuse me. There's unlimited down to zero, so almost unlimited profit potential with capped risk again. So whatever you buy that option for, that's your risk. And again, you can sell your put option at any time. So to cut a loss, lock in a profit. Or if you want the protection to cover you through a certain period of time, if you're a hedger and you don't need that protection anymore, then you should take that off your books. Allows you to stay with the trade again, be able to sleep at night knowing your risk. And the position initially starts moving against you. Also allows you to ride winning trades easier, for me anyway, because it cuts the volatility. It's not like trading outright futures. It's not going to move as much, and you don't have to worry about the margin calls. So for hedgers, again, it allows you to protect against lower prices in the futures markets. If you own the physical and the market goes lower, the long put's going to help offset some or most of the loss on your physical commodity. Also, it lets a producer or an operator who's in production or holding onto their physical commodity protect against adverse market moves to the downside. And it's going to allow you to hold on to your physical and sell at higher prices if the underlying market does turn around and head higher. So you're not going to be panic selling at the bottom of a market if it starts going against you, because you put a floor in under your grain. As a hedger, you want to lose money again if you're buying put options, because that means the market is in fact going higher, trading higher, not going lower, and you're going to be able to make higher cash sales. So when you get your 1099 at the end of the year, and it shows that you lost X amount of dollars on puts, always make sure you look at where you made your physical cash sales, because that's one of the reasons you want to be long puts if you're a hedger. For a hedge put seller, the put option allows you to collect a premium while waiting to purchase your physical at a lower price if the market does go lower, which is going to lower your input costs. But again, stay truly balanced, and you should use a portion for all the premium you collect on that to buy some calls to protect against the market rally. The profit potential all the way down to zero, and it's got capped risk, and you can sell your put option at any time again. So you're not locked into it. You don't have to hold on to it until a certain date. So in selecting options, just a couple of the basics is try to ensure as a speculator that you're using your trading system or methodology, that if you're buying a call that the trend's up, and if you're buying puts that the trend's down, and vice versa if you're a seller of calls or puts. And just try to also identify a clear area you can use as a stop loss point. So if the trade's not working out in your direction, especially if you're short options, don't be afraid just to cut the loss short. That's one of the keys to spec trading, is cutting losses short. If you're buying options, you should buy them at the money or in the money. Again, go back to the math equation we went over. If you're buying longer term options, initial outlay's more, but you're getting more of a value there with time. Just use stops again if the trade's not going with you. And again, we went over the math equation. I'm not going to go over it again, but buying longer term options does give you more bang for your buck. So the next steps, if you like what you heard here, basically what we do is, whether you're a spec or a hedge, you can open an account with us for a minimum opening balance of $1,000. There's no fees, charges, etc. So if you decide to do a transaction, obviously your opening balance can be used towards the purchase of whatever it is you decide to do, whether it be futures or options. And we'll work with you one-on-one for 30 days. So you can call or email us anytime with some questions, or need some consultation, or talk about trade ideas, bounce things off of us. Or you can just use this as a resource. So if you want to call somebody to get some quotes, updates, research, trade ideas, that type of thing, that's what we're here for. Another thing, too, we can do is paper trade with you, so you're more comfortable. You can get the feel of it. Can also open you an online simulated demo account so that you can do some practice trades and get familiar with an online trading platform and keep track of things online as to your position. We're not going to harass and call you every day. If you do open an account with us, just let us know what level of service you're looking for, how you want to operate. And at the end of that 30 days, if you feel that trading options or futures isn't for you, or you're not getting the service you want, you feel like you better service elsewhere, or any reason whatsoever, you can close your account and we'll send back your $1,000 to your home directly to you in full, so there's no charges. Try to make it as the least amount of obligations and easiest as possible for you. So, buying puts or selling puts and calls may not be the right tool to use given the market price, seasonality, what the basis is doing, the trend of the market, your unique operation or trading plan. There might be other tools that may be more appropriate at different times, such as outright futures contracts, cash contracts, HTAs. However, I just wanted to go cover a few of the basics, concepts with you, in which speculators and hedgers may find that the options market could help serve them best. Again, my name is Sherwood Tucker. Thanks again for your time. I hope you learned a thing or two, and I hope I kept this under 30 minutes. I can't see. But feel free to call us anytime. Go to our website. It's right here at www.americanagmarketing.com. Email, call us directly. That's what we're here for. And again, there's only so much material that we can cover here in 30 minutes. So let's open this up to questions. And thank you again.
Okay, anybody, if you have a question, you go ahead and type it on in. Sherwood, can you hear me?
Yeah, I can hear you.
Okay, a couple questions to start off here. How liquid are options compared to the futures markets?
It depends on what market specifically we're talking about. Obviously if you trade index options, grain options are liquid. And then there's pit-traded options, and then there's electronic options. So depending on what market you're trading, like rough rice, for example, is not a very liquid market. And you can usually tell, you can get the information over the internet on some different websites, but you can also tell by the bid-offer spreads how tight those are. If they're tight, generally, the market's going to be more liquid. If it's not that liquid, the bid-offer spreads are going to be a little bit wider.
Gotcha. Okay, and then from an execution standpoint, are futures options as easy to trade as outright futures?
Well, there's a little bit more input, if you're inputting them online, once you know how to do it, no, it's pretty seamless. Wouldn't say there's just more information that you need to type in there compared to a futures contract. Obviously, you have to put the month that you want, but then you have to put whether it's a call or put expiration date, and that type of thing. And once you have it down, then yeah, it's pretty seamless. And if you're not comfortable with that, that's what brokers are for. That's what we do. So we can enter those orders for you too.
Okay. Next question is trading platforms. Are there trading platforms that offer options quotes and the like, and do they have demo accounts to play around with for a short period of time?
Yeah, absolutely. I don't know who asked the question, but feel free to contact us, like I said at the end, and we'll be happy to get you set up on a demo account where you can practice putting in futures or options orders, whatever you're looking to do. And if you need some consultation and help on doing that, we'll walk you right through that.
Okay, and last question, sometimes on the spec point of view, do traders play both sides of the markets? Like, will they buy puts and calls and go with it, or do you pretty much just choose one side?
Well, there's different strategies, and we're talking strictly on the spec side. If you're buying a put and buying a call on the same market, it's either a straddle if it's at the same strike price, or it's a strangle if this strike prices are different. So there's actually strategies that revolve around doing exactly that. You can also sell straddles and strangles too if you think the market's going to stay, kind of around the same price. If you're buying a straddle or a strangle in the options market, you're hoping for a big price move in one direction or the other.
And last question I see posted here, does the margin requirement for long options, is it about the same as the margin requirement for being short options, or is it different?
There's no margin requirement for being long options. Again, the risk is each option has a different value depending on the strike price, length till expiration, that type of thing. So there's option chains, and I wish we had time to get into that, because I would have popped up an option chain and showed you the different values. But there's no margin requirements on long options, whether it be a put or a call. It's what you pay for that option. That's your risk, and it's capped at that risk. Selling options is a different story. There are margin requirements depending, again, how far in or out of the money it is. the volatility, and there's a whole computer system that's designed around factoring the margins for being short options.
Okay. Well, that looks like it wraps up. I don't see any new questions coming in. Sherwood, I do appreciate the time you spent with us and the information you brought to the table on some really basic option stuff. Hope down the road, and I think we're planning on some more advanced options analysis and strategies, because I know this is just the tip of the iceberg. So again, I do appreciate it. And then for everybody who's attended, we appreciate your time with us. If you do have any further questions, I want to take Sherwood up on his offer with working with him for a month or so. His information's right there. We'll also follow up with just a brief email, just so you have it at your fingertips there, at least in your email box if you want to get a hold of him. And this is the last webinar for the year, so I just want to wish everybody happy holidays from me, Bob Maurer, and on behalf of Manduka Webinars and Manduka Trading. And thank you very much, and this will end the webinar.